Okay, hello everyone, I'm James Hart and welcome to a special live market analysis session where we're going to be looking at the key themes and potential opportunities in the Forex markets over the final quarter of the year to give you an idea of the developments and market moving events that you need to keep an eye on. Now, before we look into that, let's just quickly recap the key themes that have dominated markets over the last few months to give us some context. So, the summer months were a particularly challenging time for FX markets as many currencies essentially moved into a stalemate scenario as macro drivers dried up. The volatility which was expected to ensue on the back of Brexit didn't really materialize at the time. The Bank of England refrained from initial easing, and following their easing in August, we've seen a series of increasingly positive UK data prints confounding initial bearish forecasts, thus keeping the bank sidelined in September, despite having warned in August of further easing to come. Similarly, the ECB, who had guided markets to expect easing in the wake of Brexit, stood to the sidelines as they highlighted positive data and downplayed the initial Brexit impact. US rate hike expectations, which had been built around the Fed's initial projection of 2 to 4 hikes this year, deteriorated markedly heading into and over the course of the summer due to data weakness in the US and global uncertainty. Now, with the US elections ahead, the Fed remained on hold in September, noting their desire to wait for evidence of further progress towards their goals before moving on rates. And then finally, oil prices, which had been selling off steadily into the summer, rebounded and began to trade higher, fueling a rebound in risk appetite. So now, with the heading into the final quarter of the year, the battle lines are drawn around the key themes. So in terms of what we can expect to dominate the news flow over the final months of the year and the themes that we can look to position around, we have the following key areas to focus on: Brexit developments, Euro area concerns, Fed tightening and US elections, and then oil prices. So these are the 4 key themes that we're going to be discussing today. So kicking off first of all with arguably the hottest topic at the moment, which is of course the Brexit issue. So just to update on the developments that we've seen within the Brexit landscape then. So sterling has come under huge pressure recently following the confirmation last week by UK Prime Minister Theresa May that the UK will officially trigger Article 50 and thus begin the formal exit process from the EU by the end of March 2017 at the latest. Now, this confirmation has come as a big blow to many analysts who are anticipating that the UK could avoid a hard Brexit and that some sort of compromise would be struck. Clarity now on the UK's exiting of the EU has renewed investor concerns for the UK economy, and consequently we've seen sterling sold heavily. Now, the moves in the UK currency have come despite a spate of continued positive data, with PMI data sets specifically improving and beating expectations over each of the 3 consecutive months since the Brexit vote at the end of June. The announcement by PM May has caught markets offside and was much earlier than many were expecting. Whilst the UK Prime Minister has now confirmed the timing of the UK's exit from the EU, the actual terms of the UK's departure are yet to be decided. Now, over last weekend, we had Prime Minister May noting that departure from the EU meant that the UK would be in control of its own borders and that it should look to achieve the best possible deal in terms of single market access. So this suggests that the Prime Minister is willing to accept restriction to the single market in favour of controlling immigration, which of course is a key issue for many UK voters. So this would entail a hard Brexit, which many analysts expect will be damaging to the UK economy as UK banks lose their passporting ability. So for now, confirmation of the UK's departure coming much earlier than many analysts were expecting and suggesting a move towards a hard Brexit is weighing heavily on sterling. Last week, of course, we saw a huge escalation in selling pressure when sterling dropped over 6% in 1 minute during a flash crash episode in the early hours of Friday morning. The moves were algo-driven and were exacerbated by thin overnight liquidity and are thought to have been triggered in response to comments made by French Prime Minister Hollande, who urged the EU to take a tough stance on the UK during Brexit. So the current fall in sterling, which is now down over 20% from November 2015 highs, has actually benefited the UK economy to some extent. We heard BO Deputy Governor Shafiq noting that the decline is certainly helping the economy to find a new equilibrium, despite ongoing uncertainty regarding the UK's future trading arrangements with the EU. So the fall in sterling certainly been helpful in this regard. It's boosted UK exports. However, the decline is also likely to translate into higher inflation in coming months due to higher import prices. So in terms of the boost to exports and how it's improved the UK economy, we've seen the current account deficit improve to minus 5.9 in the second quarter of 2016 from minus 7% in the fourth quarter of 2015. However, further narrowing of the deficit is needed over this future period of vulnerability which the UK will experience between the triggering of Article 50 and the UK's formal exit from the EU. Now, with UK rates near zero at the moment and the room for fiscal impulse restricted by large government debt and budget deficit, a weaker sterling rate is necessary, but it's not necessarily sufficient for providing the stimulus needed to keep the economy on path. So if the UK government do pursue a hard Brexit, then they are going to need to be prepared to deal with much lower global purchasing power for as long as is necessary to achieve the desired outcomes. And indeed, the fact that recent UK data has outperformed expectations and indeed confounded forecasts doesn't alter the long-term risk profile for the UK. Now, whilst the moves that we saw in sterling last week, those flash crash moves, were reversed, the added volatility further increases bearish sentiment on the currency and worsens investor uncertainty, as the volatility which was forecast to come in the wake of Brexit seems to be finally taking hold. So let's take a look at the technical landscape in sterling at the moment. And it's a really interesting period because we've broken into some truly historic levels now. You can see that we've broken down through the trendline support that was running from the 1993 and 2001 lows. So we've broken down through this trendline support now. This was the last key technical support, and you can see that we also broke down through the 78.6% retracement from all-time lows in cable. So the break that we saw occur last week was a really significant technical development in the sterling dollar landscape, which opens up the room for much further downside in the pair. You can see the large tail on this candle implying the sharp reversal that we saw on the back of that flash crash move. However, as I say, the breakdown below this trendline support and the 78.6% retracement at the 127.76 level, if held, if sustained, this suggests a move down to test at least the all-time low at 104.86. And indeed, if we look at the technical picture, you can see that the break of this trend line actually represents the break of the neckline of a much longer term head and shoulders pattern. You can see we have the left shoulder here in the 1998 area, the head here around 2007, 2008, and then the right shoulder over here in 2014. So this is a really long-term reversal pattern that we have in play here that's developed during the course of this consolidation over the last 20 years. And so this breakdown below a long-term trendline support signals a really bearish landscape for cable going forward. So in terms of how we could look to position on this, the first key area that we're going to need to assess is going to be a retest of the underside of this broken trend line. You can see that we bounced from the 88.6% Fibonacci retracement from the all-time lows. So that's come in and added technical support for now. But the key flashpoint for cable in deciding whether or not we're going to break back above and hold, or indeed continue to trade lower, is going to be the retest of the underside of this broken area. So I'll be keeping an eye on cable as we retest that 27.76 area. And if we do roll over and start to trade down again, then this is going to be good confirmation of the likelihood of trading down to test those all-time lows in cable. Now to the top side, to negate this bearish bias, we're going to have to see some pretty significant recovery made by cable. Now obviously we have this trendline support and the broken 78.6% retracement coming in around this 127.70 area, but then really the level above there, which we're going to need to see reclaimed to negate this bearish bias, is really going to be around this level here. So you can see that we had the lows of 2008, 2009 at around the 134.41 mark, and then just above there we have those previous 2016 lows at the 138.88 mark. So we've got quite a significant ledge of broken support here. So we're going to really need to see cable coming back above 140 and really the 145 mark to suggest that the bearish bias has been negated and the price is likely to sustain a correction. However, if we can't break back above those levels, if we simply retest and fail, then it is indeed looking likely that cable is going to trade down to test these all-time lows. And in fact, we can even scope out some targets beyond those all-time lows. If we map the moves that we saw during the global financial crisis, the 2007-2008 decline, 2008-2009 decline rather. So if we take a line and map that move and then apply that to the current decline that we're in, you can see that gives us an ABCD projection, so a symmetry projection here with the equidistant leg completing around the 93 level. So we've got some significant downside targets in cable here, and for the time being, whilst we remain below this broken trendline support and the broken 78.6% retracement, we do seem to be heading down to test these levels. So I'll be keeping an eye on any Brexit developments, and obviously as we head towards the year end, there's going to be a lot more uncertainty creeping into the UK landscape, and for the time being, whilst UK data points have continued to perform robustly, signalling resilience in the economy, yet sterling has continued to trade lower. Well, this suggests that at any point these indicators start to turn lower, this is going to further exacerbate the moves in cable and provide fresh fuel for downside momentum. So coming back to our key themes then, and moving on to concerns in the euro area. Now, the euro has been particularly stagnant over recent months as ECB easing expectations dwindled amidst a raft of positive data and neutrality from the bank during their July meeting. However, events over recent weeks have prompted a bit of volatility to creep back into the euro area, with concerns for the European banking sector driving volatility. Germany's biggest bank, Deutsche Bank, is currently facing severe capital adequacy concerns relating to fines due to be applied by US regulators regarding the mis-selling of mortgage-backed bonds by the German bank. Now, analysts worry that the bank will not have the necessary capital to fulfill the fines and continue trading. And bearish sentiment has seen Deutsche Bank shares crashing lower this year, down over 50% year to date. Now, German officials are noted to be preparing an emergency rescue deal to backstop the bank if needed, which includes the prospect of the German government taking a 25% stake in the bank. Now, of course, European equities were rocked by these developments as banking sector stocks plunged. The main concern here is the level of contagion stemming from the bank, which has strong ties to the UK, France, and also the US. So these banking concerns are set to continue to plague the outlook for the Eurozone over the next few months, before the Eurozone then faces yet more uncertainty by way of the Italian constitutional reform referendum to be held on December 4th. Now, the outcome of the referendum will have a significant impact on whether PM Renzi decides to stay in office. If the referendum is voted down and reform progress takes a step back, then political uncertainty is likely to increase in the euro area. So this referendum also comes just ahead of French and German elections after the turn of the year, which adds even more risk to the euro outlook as we progress through the final quarter. However, it's worth pointing out for now that the euro seems to be unperturbed by periods of risk-off activity and remains largely supported. And the reasons for this are threefold. So one, in contrast to 2012, so in contrast to banking sector concerns in 2012, there are a wide range of operations and systems in play now to provide support for the wider economy through access to liquidity, such as the OMT, TLTRO and QE programs. Alongside this, we also have factors such as negative rates and excess deposits providing support. And then notably, the funding requirement for European banks is also much lower now than it was in 2012 as a function of the lower operational requirements for US-funded balance sheets. Then, the German policy also plays a role here. So despite the rhetoric, markets are highly skeptical that the German government would actually allow its biggest bank to fail, even in the event of significant losses being imposed on shareholders and creditors. And reports last week regarding a rescue deal firm up this line of thinking and encourage markets' expectation that if needs be, the German government will step in and rescue Deutsche Bank. And then finally, the euro's role as a funding currency. So of key importance is the change in the euro's risk relationship since 2012. So the eurozone economy now runs a large current account surplus, which increases excess liquidity, meaning that eurozone investors now typically provide rather than consume capital flow funding on a net basis. Now, this dynamic limits the eurozone's exposure to periods of risk aversion, and furthermore, acute situations that fuel repatriations tend to prove supportive for the single currency, which is obviously a dynamic which we've seen come to play several times over the last 2 years, with the euro seemingly supported during periods of risk-off trading. And then furthermore, reports last week that the ECB are looking at tapering their QE program after the March 2017 end date has added further support for the euro. Indeed, if inflation rises over the coming months, perhaps fueled by higher energy prices, then the prospect of tapering is likely to take on a more central focus and provide further support for the euro. So we have the ECB October meeting coming up in just under 2 weeks' time, next week rather, and whilst the ECB are not expected to ease further at this junction, traders will be keen to hear the bank's latest outlook and assessment in light of recent developments. And the press conference following the rates meeting is likely to be particularly market moving, as Draghi is sure to be questioned on Deutsche Bank, Brexit, and now also the prospect of the tapering of QE. So next week's meeting is going to be keenly watched by traders, and the press conference especially is likely to be particularly market moving. So with those factors in mind, let's take a look at the technical landscape for the euro dollar there. And the euro dollar price action at the moment highlights the uncertainty which has been dominating markets over recent months. And to give you an idea of just how congested price action is, if we quickly look at the monthly chart, you can see that the euro has put in a series of inside bars now. So we've actually put in 4 monthly candles which have all been within the range of that May monthly candle. So the price action is incredibly congested in the euro dollar at the moment. You can see that post-Brexit, price started to grind higher, and this was mainly a function of reduced US rate hike expectations in the wake of Brexit and the investor uncertainty which took hold. However, over recent weeks, you can see that price has entered into a really tight trading range. So we came down from the post-Brexit reaction high around the mid-113 level, traded back down, and you can see that we've since been trading in this really tight range over the last few weeks. Now, the key levels to point out here are the rising trend line from November 2015 lows and the bearish trend line resistance from year-to-date highs. You can see that this gives us a contracting triangle pattern which has framed price action over the last several months. So for now, this consolidation pattern portends a breakout on the horizon, and the likely candidate at this stage seems to be a topside move for a number of reasons. So firstly, the ECB looks to be done or very nearly done with easing. The neutral tone of their statement in recent months, alongside positive data prints and now tapering of QE, does not suggest that the bank are likely to pursue further easing. And one of the big reasons for this, according to ECB Chief Draghi himself, is that the risk reward on further rate cuts is poor, and evidence suggests that rate cuts are not affecting currency weakness. And indeed, we can see that that is something which has come to the market several times this year, with many central banks cutting rates only to see currencies strengthening in response. Furthermore, in terms of the global picture, there is a very strong need for a weaker US dollar to help stimulate growth and reduce financial stress. So with this in mind, even if the Fed does hike this year, it is unlikely to start a cycle of dollar bullishness as rate hike expectations are so subdued. Now, unlike last year when the Fed hiked in December and the market was expecting 2 to 4 hikes this year as per the Fed's dot plot projections, the Fed is now only projecting 2 hikes next year, down from 3 originally, and this is likely to be subject to downward revisions also. So ultimately, a hike this year would likely be a dovish hike from which the USD would trade lower. Now, of course, there are risks to this outlook, with much political and banking risk in the offing. However, it is worth noting that over similar periods of risk-off trading over the last few years, such as the Greek crisis, we've seen euro downside bets failing to prove worthy due to the dynamics which we discussed earlier. So the euro is likely to remain supported in the event of any of these risk-off events. And for now, I'm looking for a topside break to take place. So I'll be looking for a break of this bearish trend line for the market to move higher. And the key price pivot for me is really this 114 level, more late 113. So around the 113.80 to 114 mark, you can see this has been a key resistance level for the euro dollar over the last 2 years. And several times we've tested this level, and each time the market has been rebuffed and turned lower. Now, admittedly, on some occasions you can see that price capitulated well above the level. However, each time we have in fact reversed and traded back down below that level. So this 113.80 mark, this is a really key price pivot for the euro, and if we can sustain a break above that level, then that does suggest that a broader breakout is in play. Now obviously we'll update these outlooks at our upcoming live market analysis sessions, but this is just to quickly give you an idea of longer term levels which I'm looking at as key determinants of price action direction over the coming months. Now obviously if the euro breaks to the downside, we'll move on to the US dollar now after this. So if the euro does break to the downside, potentially on increased Fed hawkishness, and the levels which we really need to keep an eye on for the euro are of course first of all the local structural support which comes in at the late August and September lows around the 111.20 mark, and you can see we also have this rising trend line support. So we actually tested this last week on Friday. We dropped down, tested this level, bounced and came back above it. So for now the bullish bias is still intact, and I'm still expecting for a breakout to manifest. But if we do break to the downside, then the key levels to look for as signposts for engagement are first of all a break below this level, where we could then look to position on a retest of the broken trend line and broken structural support for a move to the downside. And then the bigger structural support comes in at this 109.60 level. So if price does break to the downside, the move that we would be looking to scope out as a target would be this symmetry swing here. So the larger ABCD pattern completing down into the 106.30s. So we've got a top side and a downside scenario scoped out for the euro dollar there. So the key levels that we're looking for are a break of 114 signaling a topside run, a break of the bearish trendline resistance rather, targeting the 114 level, and then a break above there which suggests a longer term breakout in the euro, and then to the downside a break of this 111.20 area with the rising trendline support, looking for a retest and a hold to signal a move down to test bigger support at the 109.60 level. And then if we break the 109.60 level, shorts can look to target a completion of the longer term ABCD pattern which completes into the 106.30 level. Just to interrupt quickly, guys, I can see that one of you is having audio issues. I suspect that this is due to your individual connection. So unfortunately there's nothing I can do about that. However, we will make the recording available to anyone who's had any audio difficulties. So we'll make sure to get that to you via email. So moving on to the US dollar then, going back to our key themes. Okay, so the first issue to address then is of course the September employment reports, which came in weaker than expected, with the headline non-farm payrolls print reading just 156,000 versus 174,000 expected. And alongside this, we saw the unemployment rate in September ticking up to 5%. Now, these figures drew a lot of attention as they were the first labour market readings since the Fed's September FOMC meeting, which saw them keeping policy on hold as they await evidence of further progress towards their goals and further strengthening of the labour market. So at the September meeting, we saw the Fed citing their expectation to raise rates this year, but we also saw them reiterating their data-dependent stance. So with the non-farm payrolls now missing 2 months in a row and the unemployment rate ticking back up to the highest levels of the year, we saw some significant give back in the US dollar on Friday as traders reacted to the data. However, it's worth pointing out that despite some initial USD weakness in response to those weak data prints, rate hike expectations for December remain firm. So you can see here that we have the CME Group's Fed Watch, which gives the implied probability for upcoming FOMC meetings. The December implied probability has jumped up to 64% from 60% prior to the number. So despite the weakness seen over September, traders are still wagering that the data remains robust enough to keep the Fed on course to raise rates this year. Now, 150,000 jobs per month is still well above the level that the Fed has previously given as sustainable, and last week's ISM prints add further support. So we saw the ISM manufacturing data on Monday beating expectations, printing 51.5 on the month versus 50.4 expected, and then a similar rebound in ISM non-manufacturing, which printed 57.1 versus 53 expected. So the market has been trying to get behind the idea of a US rate hike, with upticks seen on any positive US data and in response to any hawkish Fed commentary, but continued underperformance of key data sets is continuing to pose a challenge to the hawkish argument. Now, over recent weeks, we've seen a slightly firmer US dollar across the board, notably in dollar yen, which suggests that some of the risk premium priced into the greenback ahead of the US presidential elections has been taken out to reflect the strengthening of Clinton's lead in the wake of the first two debates, which have largely seen her dominating her Republican counterpart. So Clinton was able to carve out a lead in the first election, with initial post-election polls comfortably giving Clinton the lead. And this was seen again last night. A CNN poll conducted after the second debate saw 57% of participants claiming victory for Clinton versus only 34% claiming victory for Trump. Now, the lower probability of a Trump presidency can be clearly seen in the US dollar against the peso. So the Mexican peso has been largely used as a barometer for the Clinton-Trump skew, with Trump dominance affecting a weaker Mexican peso as his proposed policies, which include strict restrictions on Mexican trade and immigration, are expected to significantly weaken the currency. For now, you can see that the peso has made a solid recovery against the US dollar. The US dollar has now fallen well below the pre-first debate highs. So this was the level of the first debate. You can see that the peso has strengthened considerably, with the US dollar falling well below that level. So key for the direction of the US dollar over the first half of the final quarter is going to be the development of the US elections. If Clinton can continue to carve out a strong lead in the polls, then the US dollar is likely to remain supported, keeping the dollar-yen base at 100 intact. So if we quickly take a look at the dollar-yen, you can see that this 100 level, which is a key psychological level, has been tested several times over the last 4 or 5 months, and each time price has been rebuffed. And you can see that notably over the last couple of weeks, price has in fact broken out above the bearish trendline resistance, which has capped price since around May of this year. Now, we're currently challenging key local resistance at the August highs around the 104 mark, and this is where we're stalled for now. So again, the recovery in the dollar on the back of Clinton carving out a stronger lead in the elections has taken some of the risk flows pressure off the dollar yen. So when we see markets in risk aversion mode, the Japanese yen is typically well bid due to safe haven inflows. And obviously at the moment, with risk sentiment remaining supported, we're seeing some weakening of the Japanese yen, which is allowing this recovery in the dollar yen to occur. So going back to the elections then, and looking ahead to the second half of the quarter and the likely USD response to the election results. So again, a Clinton win will likely be seen as a mild positive for the US dollar and for risk sentiment, avoiding the more extreme policies and general unpredictability of Republican candidate Trump. So taken in context then, this should allow the Fed scope to tighten if it judges the data to be firm enough. However, a Trump election will likely keep the Fed sidelined, as we can expect heightened uncertainty and general risk-off trading to impact markets and investor sentiment negatively. And the Fed is not likely to then look to add to those conditions by raising rates. So there are two key elements to keep an eye on here. The first is the development of the presidential elections and the results, and then also the economic data that we get over the next few weeks and months. So whilst a Clinton win is likely to create a more favorable and more conducive environment for the Fed to raise rates, if data performs poorly over the next few months, then despite Clinton winning the election, or despite the potential Clinton winning the election, the Fed are still likely to remain sidelines. So we need to keep an eye on both of these factors as we head into the final weeks of the year. And then finally then, the last key theme that we really need to consider over the last quarter of this year is that of oil prices, which have been dominating the news flow, particularly over the last couple of weeks. So we had the informal OPEC meeting, which took place at the end of September, and markets were taken largely by surprise on news that the group had agreed a production freeze. Now, the finer details are set to be discussed at the upcoming OPEC meeting in November, but the initial market reaction to the news has been a steady surge of demand in oil, and this demand has further been increased. Last week we saw Iran calling upon non-OPEC members to support the market by agreeing to production cuts and thus boosting the price of oil. So those remarks by Iran have helped assuage some investor skepticism in the wake of the news last week. This week, we've then heard the Saudi Arabian oil minister commenting that he is optimistic regarding the deal and the discussions to be held at the end of next month. The minister is due to meet Russian Energy Minister Novak this week to further discuss the proposal. And indeed, just today, we've seen the Russian PM Vladimir Putin suggesting that Russia is going to comply with the output freeze deal. So this has further supported moves in oil and caused a large rally over today. However, there are still some concerns regarding the likelihood of the deal being fully implemented, and over the week, OPEC's second largest producer, Iraq, stated that they want to actually raise output levels in 2017. For now, however, and especially in response to Putin's comments regarding Russia's cooperation, it seems that markets are encouraged by the developments in oil remains bid. So let's take a look now at the technical landscape in oil. So looking at the technical picture then, you can see that this supports the idea of higher prices. If we just zoom in quickly, you can see the large rally that's taken place in oil today on the back of those comments by Vladimir Putin. And indeed, looking at the broader price action, you can see that what we actually have here is an inverse head and shoulders pattern. So we have a really large bullish reversal pattern that has been taking place over the last year and a half. So we have the left shoulder back here in August 2015, the head down here in February of this year, and then the right shoulder in August of this year. And you can see that we're currently challenging really key resistance, which is actually the neckline of the pattern, 51.69. So this is the key price pivot for oil at this level, the neckline of the inverse head and shoulders pattern, and a breakout above this level suggests a much larger correction higher for oil. So if we do sustain a break above here, if commentary regarding the likelihood of the OPEC deal coming to fruition continues to remain supportive and players continue to get behind the oil move, then we are likely to see a breakout above this level. And for any longs which take place on the back of that breakout, the level which we should be looking for as a target is a completion of this broader ABCD pattern, which completes up into the 64.93 level. And you can see that this is actually a really key level for the oil market. If I just refresh my lines here that have gone a little bit out of sync. So you can see that we also have the bullish channel resistance coming in at around that level. And then we also have the 2015 high slightly below that level at 62.65. So we have a lot of technical resistance, a lot of confluence between a lot of technical resistance at that level. So if price does make a sustained break of this 51.69 level, then this is the area which we should be looking for as a clear target on the trade. And indeed, we're likely to see some longer term selling interest step back into the market at that point. However, if we do manage to make a move up into that level, then we should be looking for any correction lower and a retest of this broken neckline as an area to get long again. Indeed, what we could see take place is in fact this symmetry move. So we could get a pullback of equal length to this last retracement in the bullish move, into this rising trendline support, into this broken resistance, and then this could be a really good area to look to position to the long side for a further move higher. So again, conditions in the oil markets at the moment, in respect to the fundamentals specifically, are supporting a breakout in oil. And indeed, looking at the technical picture, the presence of this big inverse head and shoulders pattern suggests that conditions are tightening and that the oil market is likely to sustain a breakout. So again, the targets for this move, if we do make a breakout above 51.69, are up into the 2015 highs at around the 62.60s level, and we also have this bullish channel resistance coming in just above this level also. So if we do get this break higher in oil, then that's going to create some interesting conditions in commodity blocks, specifically the commodity FX block. And one of the last opportunities which I'll be looking to take advantage of over the next few weeks and months is in fact a breakout in the Aussie. Now you can see that the price action in the Aussie is very similar to that of the euro at the moment, where we've really stagnated into this tight trading range. However, a topside break in the Aussie as with the euro, looks attractive from current levels, given this contracting triangle pattern that we've got in play. So if I just get rid of some of these lines so you can see this more clearly. So you can see the current price action which we've got is the Aussie moving within a broader bullish channel, but now consolidating in this contracting triangle pattern. So what I'm anticipating that we're going to see, and potentially the catalyst which could serve to fuel this move, is the breakout in oil and a rise in commodity prices, is that the Aussie is going to break above this bearish trendline resistance and thus open up a move into higher territory. So if we do make a breakout above that level, I'll be looking to get long, targeting a move higher in the Aussie, and the target for that move is going to be a completion of the broader ABCD pattern. So this symmetry projection which completes into the 81.48 level, which you can see is around the mid-2015 high. So we've got a really clear target in the Aussie, and again, as with oil, we've got a confluence of technical factors there creating resistance, which make this a likely target and indeed an area where longer term sell interest is likely to kick in. So we've got the symmetry move completing into this level. We've got the presence of structural resistance with the mid-2015 high, and then we've also got this bullish channel resistance. So this is likely to be an area where we get some give back in the Aussie. Now, it could be that the Aussie only moves as low as to retest this breakout zone before trading higher. But indeed, in terms of playing an initial breakout on this move, I'll be looking to trade long from here, targeting a move up into that 81.48 area. And that's where I'd be looking to get out of this move. So again, some really key levels to look for in the Aussie. And again, the price action at the moment is suggesting that a topside break is the more likely candidate. So I'm not going to be looking to engage on the downside in the Aussie for now. I'm going to be waiting to see if we do get a manifestation of this breakout. And obviously the Aussie has continued to perform robustly against the US dollar over recent months, despite commodity block weakness, and the comparative high yield of the Australian dollar within the G10 currency space continues to see it being an attractive destination for foreign capital. So I'll be watching the Aussie then over these next few weeks to see if we do get that breakout higher. So we've discussed quite a few different elements here. And we've also really outlined a base case scenario, which is where we're looking for oil prices to rise, with the euro rising and the Aussie rising, and then looking for some US dollar weakening. Now, of course, there's obviously a lot of risk to this outlook, and the difficulty in presenting an outlook for a quarter, especially with so many themes in play like this, is that where the themes are so particularly dynamic, it's really important to keep an eye on developments and news events as we move through the quarter. And so we will, of course, be updating this outlook with our live market analysis sessions, and where any of these outlooks are subject to a review, then we will of course update on these and bring you the new setups as they come. And of course you can keep a track of all the key market developments on the website as we go through the month and over the final quarter. Okay, so just before we wrap this up, are there any questions that I can take for anyone? Again, for any of you who joined late, or if you had any audio problems, the recording of the webinar will be made available to everyone who subscribed for the session. So you'll get that over the next few days at some point. Okay, great. Well, I'm glad that everyone followed that so clearly, and I hope that was very helpful and you're understanding clearly the situations that I've outlined and the key technical setups which we've discussed. And I look forward to updating you on the progress of these moves as we move through the final quarter. Thanks a lot, everyone. Take care.